if many of you don't know my background, I was an options market maker for about 12 years, and then ran a volatility hedge fund for a few years, and then managed almost $1 billion in option overlay ETFs, so covered call funds, black swan funds. So these are funds that effectively buy downside tail risk protection. And so, which would have come in handy last Monday on a move like that. That was pretty amazing. You don't see that too often. That was sort of the Volmageddon for the current age, right? We had a Volmageddon back in 2018. And I think a lot of people, of course, during COVID, people got involved in trading and options trading, and we've had this whole new influx of fresh traders into markets over the last few years, and that's terrific because the more people are interested in basically being in control of their own financial destinies, the better, in my opinion. But at the same time, I think sometimes the risk is that we haven't seen some people who've sort of come in the last couple of years haven't seen a tough market. And that was a little shot across the bow that sort of harkened back to some times where, in the old days, we used to have sell-offs a little bit more frequently. And so that it's not that it was unusual. It's, 7, 8, 10% sell-off is something that we would call healthy, right? They use that word healthy, even though it doesn't feel very good. And it certainly doesn't feel healthy when you're in the middle of it. It tends to be considered healthy because it sort of shakes some people out, shakes some of the excess out of the system. And I don't think there's any question that we've had a lot of kind of, you call it comes in different forms, but it really all is something similar, which is leverage and borrowing. And so we saw the Japanese carry trade unravel a little bit. And that's sometimes it doesn't take much, right? The markets, and people are confused. They go, oh, how could a quarter point make such a big difference? A quarter point hiked in Japan. And, markets pay attention to things at the margin. So never underestimate the amount that a small change can make, especially when so many people are on one side of the boat. So we had this incredible concentration that everybody saw in these sort of 7, 10 stocks. And so the carry trade, probably some of it is borrowing to buy more of those stocks. And the better those stocks do, the more fund managers feel compelled to buy more of them. They don't want to get left behind. So many fund managers are out there going, boy, here's yet another year where active management struggles, because if I didn't own 5 stocks or 3 stocks, I'm behind the curve. And that's a tough thing for active managers to look at every year. So eventually they kind of go, all right, well, here we go. I guess I better own Microsoft and Nvidia and a few of those names. And then sure enough, that was kind of one of the signs. We looked at realized volatility. So for folks out there who don't know what that is, that's actual volatility. So there's implied volatility, which is option pricing, and then there's realized, which is, how much have things been moving lately? And we saw incredibly low levels, something similar to kind of 2017, which was like watching paint dry pretty much the whole year. Something awful from a trader's perspective. If you were long, it was okay because you didn't lose any sleep at all. But from a trader's perspective, where you want a little bit more movement and a pullback once every, few days, at least every few weeks, you didn't get what you wanted. So it was a bit like that. And then, of course, we've had some other stats that sort of showed that upside movement has been more drastic than downside. So in essence, we've been crashing up. So, and in fact, we saw skew kind of take the shape of this expectation that things are crashing up. We've seen it in Nvidia. We actually saw it in index in the Russell 2000. We saw upside skew more rich than downside, meaning out of the money calls more implied from an implied volatility standpoint, more expensive than out of the money puts. You never see that on index. That is incredibly rare because generally the whole structure is skewed to the fact that people are generally buying insurance to the downside. People aren't usually worried about the right. What's my risk? What's my FOMO risk. And so we were starting to price in a lot of upside FOMO risk. And so that might have been another sign. And of course, this is all easy to say in hindsight, but very, very interesting market. And then if we kind of go to if we look at things like, let me take a look here. Yeah, then we pushed on the spring here. I wanted to sort of mention this, which is when you look at these charts, and a cup and handle is a good example of that, where you get this kind of pullback and you shake out a bunch of weak sisters. And oftentimes I call this pushing on a spring. And it's oftentimes that after this big down move, you get a strong, sustainable up move. Why? Because everyone pushed on that spring. Everyone got on there and started to get bearish again and said, oh, okay, things have finally changed. We can start to worry about markets again. And of course, once we spring back, there's nothing in the way. And you have this incredible move. And that's kind of what we've had lately. We've had this amazing spring back in markets. Now, I would say if we look at the S&P, if we look at the daily here, we've got a little bit of room. I would say, at this point, probably not out of the ordinary in terms of what a bounce back can accomplish, because we've filled the gap here. We've kind of come up to just about this sort of trend line here. So sure, can we get back up into kind of maybe around 54.50, 54.60? That's possible. But then I think we sort of run into a little bit of trouble. And of course, S&P is one thing, but the NASDAQ is really sort of where the generals are, right? That's where that's where the engine of growth has been very much. Of course, there's a lot of that in the S&P 500, but this is where it really gets quite concentrated in that technology trade. And so we've got a little bit of a bounce back here, and we're coming right back to where we started to see weakness. So the weakness was led by the names that had done so well for so long. And that was your kind of, your kind of tell was that finally the Microsofts and the NVIDIAs were giving it up. And sure enough, that bled into some other things. And we got to pull back everywhere, including that Russell 2000 trade, which I thought, I'll be the first one to admit, I kind of like this idea of a rotation. But in a true sell-off, which last Monday that was a 6% overnight on the NASDAQ, 4% S&P. This is when you're talking about a liquidity event. And so just like in 2020, you looked at things like gold, for example, which is typically a safer haven. Okay, everybody rushes into gold because this is a place to hide. Gold sold off quite strongly as well. Same thing happened in 2020. They smacked the heck out of gold. And so in a true liquidity event where people are raising money wherever they can, they will sell safe havens. They will sell places to hide. Now, the bond, that's where the bond, the 30-year and bonds actually did represent some sort of safety, because the money did have to eventually go in there. We're thinking about, that's kind of where the rate cut narrative lives. But everything else just becomes a stock, right? I mean, everything else is a stock. Look at Bitcoin miners. Bitcoin's still in okay shape, but they're tossing miners out the window. They just turn things into stocks because that's where they can raise some money. So the question is, are we still in a liquidity type event? I would say probably not. It's looking more like it was a bit flash crashy. That was a little bit flash crashy. And so what we talked about yesterday with Jim and Dave and David was about how last week, and I hosted the Leduc trading room for the whole week. And even on the Monday, I said, this is scary. And as a trader, I'm a little worried, and I'm watching things very carefully. As an investor, I'm loving this. I just think this whole, unemployment's going up and things are breaking in the economy. There's just very little truth to that. There's just nothing credible out there to support this idea that anything's really breaking the economy. So we've got Restaurant bookings, fantastic. We've got uh, air travel data, fantastic, coming down a little bit as it does seasonally in August. So nothing out of the ordinary there. In fact, we're still, well above 2019 levels. Okay, and YOLO'd into experiences and traveling and enjoying life again. And so there's really not a whole lot to worry about. And even on the employment front, since we're talking about charts today, let's look at some data in chart form. Look at job cuts heading straight down. Can these things change? Of course they can. Of course they can. Is it sometimes looking pretty good? Do things look good before they finally turn down? Yes, there is some evidence of that as well. Throughout history, things tend to look pretty darn good before they head over the cliff. But for now, we're just really not seeing very much job cuts heading straight down. These unemployment numbers are nonsense. We just have an increase in supply of people, an increase in supply. So for now, like Leslie Nielsen in Naked Gun, nothing to see here. But I think for real, nothing to see here because there really isn't anything exploding in the background at this point. Very little. We've got this immigration very, very strong. That's adding supply. And, overall, I would say look at it. Nobody's talking about recession on earnings calls this past season. Numbers were okay. Sure, there were a couple of companies that said, "Oh, we're spending a lot of money on AI," but look at recession mention on earnings calls. Nah, nothing. And look at S&P earnings per share. Fantastic. Record earnings per share. Where's the problem? So I don't see the problem. And so that doesn't mean we don't have to stay nimble and keep on our toes as traders because things can change at any moment. But for now, this whole idea that last Friday's, job number foretold of something terrible happening there, it's a complete fiction. It's a complete fiction for now. It may not stay that way, but it really, really is. There are just too many people who've done well in the equity markets, in housing. People are sitting on record amounts of housing equity. And then again, with this rally back, look, there's a wealth effect. I will admit that. You get the market down 20%, there's going to be some wealth effect reversal. But right now, it's not happening. So not too worried. So I think we just have to kind of chalk this up to a bit of folks just kind of not really, and this happens every so often. People just kind of throw the idea of protection out the window. So this idea that you have to own downside puts, and I mentioned that I ran a couple of black swan funds. The first half is great for buying protection, right? When do you want to buy protection? Before the house is burning, right? Before your roof is burning. You call up the insurance company when your roof is burning, they're not going to give you as good a rate. So, and what happened was nobody was interested. The desire for protection for your portfolio was at like 8 or 9 year lows. Maybe that was another tell as well. But was it a tell at 5-year lows? Not really, because they went to 6-year lows and then 7-year lows and then 8-year lows on something we call skew. So that's the tendency to buy out of the money puts to protect your long equity portfolios got very, very cheap. And what does it do? When you have very, very cheap protection, what does that implore people to do? Own stocks with protection. So sometimes people say, oh my goodness, look at this. The 10,000 puts just went up. This person must be bearish. It's, the sky is about to fall. These guys are super, super bearish on the market. You might be looking at that completely the wrong way. The ability to buy cheap protection allows you to stay the course and stay long. Now, protection's gotten a little bit more expensive because we were reminded again last week that downside moves are possible. So skew has popped up. We can see this real big outlier of a move from a skew perspective. Skew measures kind of out of the money puts versus out of the money calls. And so everyone's been reminded that, hey, yeah, stocks can go down. But again, we just pushed on the spring and we're bouncing back here. Now, do we hold? Well, definitely. We want to watch some of these levels here. The VIX is back into the 18s, which I think is getting maybe a little bit on the cheap side, considering the events. We've got some Iran, Israel potential, powder keg potential. We've got the election coming up, and the VIX futures are now pricing in a lot more uncertainty from that perspective. Because when we had Trump way ahead of the game, everyone kind of thought, okay, Trump. Even though I think they get that wrong too. I think there's enough evidence that a Democratic um, uh, governments actually do just fine for stock markets. So I don't think that's necessarily a great thing if Trump is in power. They approach things a little bit different, certainly from a tax perspective, but uh, I think that's a little bit overdone. But we're starting to price in more of that neck and neck race that we have there, right? The potential for disruption and people denying results and craziness and people setting fire to cars and those kinds of things that wouldn't happen if Trump was a far and away winner, or if Harris was a far and away the winner. So we start to price in some of that uncertainty, and then we've got August and September. These are seasonally very, very difficult months. September is a very difficult month for stock markets. Now, the big question is, have we pulled forward a lot of that? Have we pulled forward this idea that August, September, and the first part of October can be difficult? Did we just get that out of the way as we shook a lot of people out who thought we were heading to 4,800, 4,900? I was hearing some calls about 4,300, 4,400. Possible. It's possible. I wonder if Tom Lee's back on TV this week going, no, I told you everything was fine. Um, Nothing like a good dose of Tom Lee when you need your bullish juices flowing again. So let's see. Have we got any here? We've got something going on in chat. All right. TK. So we got some questions here on some stocks. Let's take a look. Let's take a look at TK. Giving me a little bit of trouble on here. Let's get a half decent chart going for you guys. TK, yeah. So, I think obviously it's starting to come back a little bit. I don't. It's some sort of marine type stock, not acting great. I'd say this is in sort of caution mode. I think, of course, this is the sort of stock where you're trying to play for a bounce back. Now, one of the things I teach in my programs is really don't fight the trend. I'm not a big fan of playing bounce backs, except in very, very favored sectors. Maybe semiconductors, things that are kind of that tend to get that flow back in when the markets get the all clear, then people tend to flow back into things like that. But trying to trade, for bounces and things like Nike, and I can't use Starbucks as an example anymore because it's had that wonderful move to the upside today. But stocks that are really out of favor, I don't like getting involved in too much, particularly on the call side of things. So I don't know if Sam, if you're interested in trading options on something like this. I feel like one of the big mistakes I see, and a student of mine just went through this recently with Amazon, and they kept buying calls on the way down. And I said, what are you doing? You're buying. First of all, when you're buying options, you need momentum on your side. Because when you're buying options, you tend to be buying something that is overpriced. You tend to be. Now, if you guys know what the volatility risk premium is, it's a sort of measure of how much are people paying more than what is fair value on options. And it tends to be positive. They're too much for options. Options, especially in the world of equities, tend to be too expensive. If you compare to many, many other asset classes, options tend to be expensive on equities. Why is that? Well, because typically people are buying protection. People are paying up for protection to protect portfolios, to protect, there are people who are mandated to do that, people, managers and pensions, et cetera, institutions that have to protect their portfolios. And that tends to skew the cost of options upward. Because of put call parity, it doesn't matter if you're skewing up puts, it all has to kind of move a little bit together. There's differences in skew, but generally options tend to be expensive on the equity side. So when trading options from the long side, you've got to have momentum on your side. You just have to, because otherwise you're basically catching a falling knife and you're already behind the eight ball with trying to pay up, especially after a big sell-off. You're going to probably pay, let's take a look at TK over here. Let's go. Implied volatility is kind of middle of the range, like not super low, not super high. I'd say probably you've got implied volatility or you've got historical volatility a little bit higher. But one of the things I would caution with comparing historical and implied is a lot of the time people are going to get it wrong because they don't understand the direction of volatility. So the direction is very, very important when it comes to volatility. You cannot just look at the difference between implied and historical. So you can't say, well, implied is 25 and historical is 35. You need to know the direction of historical volatility. Is it coming down? And if that's the case, then your options may not be expensive. They may not be cheap, rather. They may actually be a little bit on the expensive side. What do we want when we buy options? We want expanding historical volatility, or we want edge from somewhere else. Could be a breakout, could be news that's come out. Earnings have come out, and now this thing is gap and go. It's going to gap and go. Now you've got momentum on your side. You've got something that you can work with here. So I'd say for TK, the one positive here is that, we're down near the lows that we established going back about 7 or 8 months. So from that perspective, you're okay. From the perspective that this thing is cheap, I don't know enough about it. I like to be involved in stocks where I understand the narrative, I understand the storyline, a strong storyline, whether that's, obesity drugs or semiconductors, which I think is very injured at the moment. I think that storyline is very injured, but I like something. So I'm going to assume, Sam, that you've got something positive from a kind of a fundamental, from a real standpoint that gets you maybe a little bit excited about this. Whatever this was that drove it from 7 to 10, maybe this is something that is still valid, right? Maybe this is something that you can still hang your hat on from a positive narrative standpoint. And if that's the case, then looks interesting. Give yourself some time. So especially when buying options, you want, another one of my rules, first of all, have momentum on your side. Another rule is definitely give yourself enough time to be right. Now, even if you're paying, give yourself time, because, how many times I've seen people be right, but their options expire, or, they're just way too early. That just happens all the time. So the key is give yourself time. What can we control in markets? We can't control price. We can control how much time we give ourselves. So we have to sort of grab the one thing that we have control of, and that's the ability to sort of dictate, well, how long are we going to give ourselves for this trade to be right? And so I would be, it's starting to look kind of interesting in here. I mean, broader market, I'd like to see some things kind of stabilize a little bit. Now, one thing I like to use in the program that I teach, we use something called the MTI indicator. And so this is a number of different indicators that that give you this sort of idea of where do we need to step back and let a stock do the work for us, and where can we start to hedge, where can we start to crush a little bit more premium. So, kind of like my new program is called Crush the Premium. And so the idea is that there are times where the stock is going to do some of the work for you. And so I think that's something you want to recognize here, even though you don't have the indicator. It's, you can throw together some moving averages and a few things that work for you, and understand that when things start to look like right here, things turn green for one day. I like them to turn green for a couple days. And so sure enough, we've had a period in here where things are just sort of sitting around. And then in here, we go double green, light green, which is sort of a light buy, and then full force buy right in here, which is interesting because these are a couple of down days. And we're not yet breaking out through this channel. But the indicator gives you that, that go ahead. And so sure enough, boom, we go. There was another one. I was kind of looking at Tesla, and we get that here as well. So we get this nice little breakout above here. And so this area here where you're red and yellow and zeros and ones means hedge aggressively, crush the premium. Sometimes you even get lucky and you get higher implied volatility, which is going to pay you more, right? You don't see volatility when the VIX is 12. I have people reach out to me. They go, "Oh, Hans, I keep getting run over on my covered calls." This is back in like February, March. I'm like, what are you doing? Why are you selling calls into very, very little premium? VIX 12, I mean, I'm generalizing, obviously. VIX 12 doesn't mean everything is the same, but I'm using this as an example, a proxy for general implied volatility and option pricing. When option pricing is really, really low, a lot of the time what you've got is stocks that are probably just rallying. Don't get in the way. Let your stock do the work for you. I'm assuming that you've done some of the work and you're trading a stock that is of quality, that is of a kind of stock that you wouldn't mind owning for six months to a year. Otherwise, you probably shouldn't be trading it. Now, I know there are people who trade things for very, very short periods, and that's fine. I know guys who trade for pennies, and they're looking for just in and out. But generally speaking, I try to teach people, don't go near things unless you understand them a little bit and you wouldn't mind owning that stock, especially when you're selling puts, doing covered calls. You basically just own that company. And if you do it on a 400p stock that goes from 230 to 40, like Square did a couple of years ago, now you're the proud owner of Square for who knows how long, maybe the next 10 years for it to break even again. So I always tell people, listen, first and foremost, fundamentals are important, valuation's important. Don't bother with crap. Why? There's so many great stocks out there. You want volatility? NVIDIA is a great quality company. Microsoft's a great quality company. Amazon, then you can get into all sorts of things. Home Depot, cybersecurity, you can get into all kinds of quality stocks. Why do you have to trade like crap? And crap is where people get in trouble because they try to pick the bottom. And the problem with picking the bottom is you pick it again and again and again and again and again. You pick the bottom like 10 times, and before you know it, you own some crappy stock, and your cost basis is in the realm of like Jupiter. You never get back there again. And that's what really buries accounts. Good trades are great. I saw this again the other day. This guy was like, "Oh, look at my win rate." Like, that's meaningless. Your win rate is 80%. Who cares? What's your overall performance? Your win rate can be 95%. And that last 5% costs you everything you made in the first 95% and then double that again. Win rate is meaningless for the most part. And so I find that it's the get in trouble trades that bury your account. You know that feeling when you're like, wow, I did well for 3 months and I just gave all of it back and maybe more. What happened there? You probably didn't want to admit you were wrong. And so anyway, trading, that's my little rant. Here's your Tesla, meander along here, and then you get this beautiful you get this beautiful sort of 2 or 3 days of green. And then sure enough, not that anyone's Nostradamus here. We have no clue what the stock market's going to do. But one thing we do have is technicals. One thing, and technicals are a reflection of people doing things. Important people, unimportant people, but important people too. And we can jump on board, just like Dan was talking about in the last segment. He said, I like to watch big trades. I want to see institutional trades. I want to see what the smart money is doing, because little folks like us, we can jump on and say, yes, sir, that looks interesting. Charts are doing that. We see big spikes in volume on big moves. That's a sign there's good money getting in there. We'll post some links in a bit, John. But thank you for asking. Let me see if I can grab this here. Oh yeah, where was that actually? Oh yeah, down here. I'm going to post right here. I have a free 4-day options challenge course that I've just released this week. Actually, pretty good timing with today's presentation. And really cool. 4 days, I'm going to give you all sorts of really cool, actionable things that you can do in your trading. And it really talks about the pillars that my system is founded on. Just these pillars of quality, of technicals, of options edge, of where to kind of put all that together in order to extract value. But it all starts with quality, right? It all starts with having a tailwind. And I tell students that in my Discord all the time. I say, listen, you got to get out of some crappy positions. If you're trading to make money, if you're trading for regular income, and a lot of people do that, they sell options for monthly income. That's well and fine, but you need to be able to get out of those positions when things start to go wrong. And that is the hardest thing. And I'm not saying that's easy. I'm not pretending that that's easy, but write this one down and post note it to your computer. The last trade of a good campaign is usually a loss. And this has really resonated with some of my clients. The last trade. So let's say you're trading something, you've got something going on here. You are trading, let's say it's SMH. Guess what's going on in here? This is a fantastic run of put sales probably in here, right? You're selling puts, you're selling, you're covering, you're selling, you're covering, you're selling. You've got all this wonderful tailwind behind you, and you've put a bunch of money in your pocket. Let's say you've made $5,000 on this whole run, and then things start to break down here. S&P starts to break down, and this is a new picture, isn't it? You know how many people I saw trying to buy semiconductors all the way down here? Tons of people. And I don't know why they don't see the transition. This is a transition from this to this. Everybody can make money in this. Only a pro, only somebody who thinks like a pro can avoid this turning into losing all the money that you made before, right? And so here, this might involve taking a $1,500 loss. You made $5,000 and you're going to lose $1,500 here. And you're going to be happy you did. You're going to take that $1,500 loss and you're going to crack open a beer, because that is it. You're not going to lose more than $1,500. Remember that saying, your first loss is going to be your worst, because it won't get any worse than that. Your first loss, that $1,500, is a celebration, because you're not going to turn it into a $10,000 loss. And how many times have we seen that lately? People trying to catch a falling knife on Dell, on AMD, on all these stocks out there that worked for so long. And recency bias is the worst thing in the world for us, isn't it, right? These psychological things. Of course, trading is 50% between the ears. Recency bias. But what do you mean? What do you mean I have to take a loss? I've made all this money here. Why do I have to take a loss here? It hurts. Yes, it hurts. The last trade in a campaign is often a loss. Unless you're so good, you just know what's about to happen here. Now we have risk gauges in our programs and in our trading rooms where we say, listen, like we got out July 24th, we said, this market, it's based on about 12 different volatility metrics. Started to see that things were getting a little hairy out there. So sometimes you can, if you have the benefit of things like that, and you can even build some of these things yourself, you can just use the VIX. You don't need my fancy gauge. Look at the VIX. What's it doing? Oh, it's traded above 20. That's a sign that something's going on. We don't know what, but something's going on. I see people, expounding about how, well, when the VIX is above 20, that's when you really start to sell premium. That's when the big money is. The premiums are really fat. And I say, you're insane. Maybe, but you need to see how things develop a little bit. But the VIX above 20, above 22, 23 is a sign that something's going on. And remember, we talked about direction of volatility. When realized volatility is pointing straight up, that's not when you want to get aggressive selling options or selling premium. Why would you want to do that? When the VIX closes at 23, 24, I'm not saying I knew what was going to happen that Monday, but when that happens, that's when you look in the distance and you see a hurricane on the horizon and you don't know, is it going to go past you? Is it going to fizzle out? Is it going to go over you? Is it going to smack you right in the face? You don't know. Why are you selling house insurance into a hurricane approaching in the distance? So we have to understand direction of volatility. And I want you guys to be able to chart those things. In Thinkorswim, you can look at direction. Here's some direction right here. You can see it pointing up. And the thing is, you will always, if you do this right, you will always miss the highs and you will always miss the bottoms. You will not, and you will not pick the high. You will not sell VIX 65, but you'll sell something down a little bit lower when it makes sense. So, and this is one of the hardest things that traders do as well, is that the reason we try to pick the bottom is because we want that feeling of, yes, I nailed it. I nailed the bottom. That is what I'm going to tell people at the water cooler tomorrow or at my next cocktail party. But the problem is you're playing with fire. And so that's why in our programs, we always talk about, look, there's a range of implied volatilities. When I look at percentile, try to look at this yourself. You can do scans for something like this, go to bar chart, do a scan for implied volatility percentile, and rank's better. Do rank. It'll give you an idea of where the option premiums are for this particular stock within the last 52 weeks. If Microsoft option pricing has been between 20 and 50, where are we right now? Are we at 50? I don't want to trade that. I don't want to trade Microsoft at 100 percentile of implied volatility. That means something's going on. Not interested. Do I want to trade it at 10 or 15? 10th percentile? No, it's starting to get a little lean there. My strikes are too close. I'm not getting much for that. Why bother? Chances are Microsoft just going from 400 to 500. Why get in the way? Like I told you about earlier, the individual who kept selling calls and having his stock called away. So I like to have something in between. The money is made between the goalposts, right? We kick the ball between the goalposts. We don't try to get close to the goalpost. That's too close for comfort. So again, when you start to use and what I like about this is, and you can just put in a 20, a 9 crossing a 20 moving average. And one of the nice things that it does is it'll allow for things to unwind, right? When you trade every day and you're watching things, you're always tempted to be that first one back in. Resist that temptation. Wait for things to develop a little bit. You're going to get your chance. You might get a little breakout and you'll get the pullback. And that's where you might get your opportunity. You get a little rally and then a pullback. That's the better opportunity. So don't keep trying to be the first one in. That's not where the money's made. Trying to pick the bottom on a massive sell-off is not where the money's made. Feels good. Wouldn't you love to have bought SMH at 200, 201? That's great. And someone's definitely going to brag about doing that. But the problem is that same person probably picked the bottom at 230, at 220, at 215, at 200. And in reality, their cost isn't, they didn't pick the bottom. They picked a series of bottoms. So what I like about some of these indicators, and it could just be a 9 crossing a 20, a 20 crossing a 50, they allow for things to unwind. And that's really what the MACD is about as well. When we look at TK, Sam, I want to see this kind of curl up a little bit more, because what this is doing is it's telling me things are still unwinding. There's still some issues here, right? This stock is still in therapy. This stock is still talking to its therapist going, you know what, I'm not feeling good about things. I'm feeling a little guilty about my performance. I let a lot of people down. It's lost some of its confidence, right? It needs to work things out a little bit. And I'd like to see this start to curl up a bit. Take a look at COLL. See, this is something that doesn't look too, I don't mind this. I mean, it's a pharmaceutical type company, so you know, take it with a grain of salt. Obviously, these kinds of companies have a bit of risk. I mean, this was quite the awesome breakout through here, through the 50. Like that a lot. Not a ton of volume on that breakout there, which was interesting. Kind of see that. The volume came in sort of around here, didn't it? It's almost like this broke out and then some news came out, didn't it? And then the volume came in and it pulled back a little. That's a pretty good pullback, maybe about a 50% retracement, kind of a nice spot, I think, to get in. Would have been nicer down around the 50 here. This is looking interesting. I mean, you could look at selling. We've got the MACD kind of starting to curl up again here. It's got some things to work out, right? This was a little bit too exuberant. A little bit too exuberant, but nice to see here. You've got this positive divergence, which was great to see. Even though this thing was consolidating, you had nice positive divergence. You had a positive MACD histogram, which I like to look at. That histogram is always, it's nice because it gives you sort of this feeling for, is the momentum waxing or waning? Is it heading sort of, is getting fatter, which is positive, or is it starting to wane a little bit, which is maybe we're starting to lose some of that momentum? In here, it's pointing straight up. And sometimes I like to use things like this as a way to keep myself in a trade, right? This is, again, where you can use technicals to really give you the ability to be patient, right? So you've got, I mean, right in here, that's not a very good example because this is heading down, even with the stock going up. Here we've got one, we're heading down, so the direction is down. So it's kind of keeping us out of trouble until about here. This is a bit of a schizophrenic type stock. So it kind of gets you in here and then you cover here. So that's fine, right? We didn't pick the bottom, but we covered here. And then I'm guessing this is some sort of earnings event, which I don't like to be involved in anyway. I like to stay away from those events. There was a study by Goldman that I read this morning, and I see people trading these earnings events all the time, selling puts and calls, and I often tell them, listen, this is a low edge trade. This is a negative edge type trade. You do not sell puts and calls. I mean, you might do a time spread of some kind, but for straight up selling cash secured puts or calls doesn't make sense. You have so many examples of, you know, even big companies like Salesforce, a quarter ago, people selling puts for all were worth $30 the next morning. It just doesn't make sense. I don't care how much implied volatility you're getting, you're taking a chance. And people who do that are trading for excitement. They're not trading to make money, because you don't do that to make money. You might make money 10 times in a row, and then that 11th time you're the turkey and you give everything back and more. So trading earnings events, not my favorite thing to do at all. And so I was telling you guys about this study that I read ago talking about covered calls, and they said much better off not selling calls against your stock into earnings events. And they talked about more things like, you know, free cash flow stocks, or you want to, you want to, you're going to get better risk adjusted returns from, stocks, covered call overlay type trades where you have high free cash flow. And they did cool things like, okay, you're going to target a strike where the amount of premium is equal to 1 times the yearly free cash flow. And those looked really good, right? 1 time free cash flow. These are kind of really cool studies that get right deep into the weeds, but give you a little bit of insight. And those are some of the things that I teach. And I say, listen, quality, cash flow, free cash flow. And it sounds kind of stupid because you're trading short term, doesn't it? Right? Why should I care about the long-term prospects of a stock? Well, you should care because you walk in one morning and you've got a trade on and the thing pre-announces and gaps down $30. Now you're the proud owner of whatever, some stock that now you've got hanging around your neck for the next year, right? So this stuff is important. You want to trade stuff that is not that quality names can't go down, but they won't stay down forever. Quality names will generally start to march their way back at some point. And I know that's a generalization. We can get multiple contraction, all these things going on in markets, but I don't mind getting stuck with an Amazon. I'm stuck in Amazon right now. I sold some puts a little bit higher. Doesn't bother me at all. Would I be worried about getting stuck in, Clean Spark or Riot? Yeah, I might. I mean, I think Bitcoin's probably going to 100,000, but if it turns into another weed cannabis situation, I don't want to hold that stock for the next 5 years before tossing it out. So quality, folks. In my humble opinion, very nice move though on SMH today from 200 to 235. Very impressive. Now, what we've got here on my MTI is we're starting to turn a little bit yellow. So yeah, is it going to miss the bottom? Probably, but my guess is we're probably going to fail and kind of pull back a little bit in here. And that's going to give our moving averages and other things that's things that we watch a little bit of a chance to unwind. And if indeed things are back on in the semiconductor space, which they could be briefly, I think NVIDIA is going to put up good numbers. We'll see how if they guide lower, because that's my worry, is that AI is a little bit under threat here. So we'll see for the longer term. But I think the numbers, everyone keeps coming out and saying we're buying tons, CapEx is through the roof on AI. We're buying. So who are they buying from? Companies like NVIDIA. So my guess is you want to be the picks and shovel maker. You don't want to be the end user. NVIDIA doesn't care if you figure out how to make money with your GPUs, right? They just want to sell you more GPUs. But what we might face over the next 6 months is companies going, I don't know, spending a lot of money on this stuff for not a lot of risk, for not a lot of return. And that's, I think, is a threat to the current artificial intelligence theme and narrative. Similarly, Dell kind of coming back, but boy, what a drubbing that thing has taken. Just bright red here on the indicator. So this thing went yellow. It went from 5-star trade green to yellow in a couple of days. So basically you held it. You might have thought it was breaking out here, went to 150. This is where I'll tell you right now, you look at this chart and back at the time, if this doesn't exist, the rest of this performance, You're looking at this going, this is starting to break out here. I'm starting to think of a high conviction put trade, which might be like selling a 140 strike, something like that. And then it reverses in your face. And this is where the difficult decisions come in. Once you start getting this breaking down, and you get into here, this is a whole new picture. So this is the remember we talked about the transition earlier. This is positive. Of course, this doesn't feel good in here, but this is all positive because we're all heading in the right direction. And then when this starts happening and the whole AI basket starts to suffer, this is where people are holding on and they're not taking their lumps. So remember, a great option selling campaign often ends with a loss. And again, it's hard, very, very hard to say, you know what, I made $5,000 in here and I've got to give back 2 of it here. But the risk is that you end up owning Dell down to $90. Now you've got some work to do, right? Now you're going to wheel it. You're going to sell some calls against it. So really, and this is the premise behind, I think the way people should be trading is they need to really, really focus. And I think a lot of time is spent from gurus and courses and guidance and teachings. A lot of people talk about how to put the trade on, good setups. Very few people talk about where to get out. And I think a lot of the time it's sort of automating the process, right? If you can automate the process and say, you know what, some platforms will do that. This thing gets down here because when Dell gets down to 135, it's so easy to second guess yourself, right? When you start trading on hope, you're hoping this thing bounces back at this point. And hope is fed by excuses. It loves excuses. Hope is like an excuse monster. Give me more excuses to make me think that, oh, this is just a Friday. It's going to come back. The volumes aren't high enough. You can come up with 400 excuses as to why this picture isn't looking good, to second guess yourself. So sometimes it's good to just, have it automated. Get out. If you're just trading this stock, boom, gone. And I know once in a while you're going to get tripped up by a stop loss on a big, a big sort of down morning or something like that. But you need to do everything you can to avoid losing $50 more on a stock, or 20 or 30 or wherever it is that you finally get out. I wanted to show you guys this low volatility environment. So here's your VIX, just kind of meandering along, 12, 13. Remember I told you about that guy who complained to me, Hans, I can't believe it. I keep getting called away. And I keep saying, listen, what was his name? Colin. I said, Alan, why do you keep selling calls? I keep telling you, look at my messages to you. Stop selling calls in a VIX 12 or 13 environment. You know why? Because this is what's happening. The market's just going up and up and up and up. Low vol doesn't mean no vol. Low vol means upside vol, upside movement. So always try to respect that. I don't have much time left, guys, but think about some of the things that I talked about today. Respect the volatility environment. It really, really is about that. And understand that transition on the chart, that transition from what was working to what is now not working. And making that connection and understanding that you may have to do something that is a little bit painful, but is going to keep you in the game in the long run. I'll bring up my little thing here again. And check this out. Doesn't cost you anything. It's free. Jump on the Crush the Premium 4-day challenge. I really feel like I put a lot of value into this. And if we end up not working together, totally fine. But if you can pick up a couple of things that really help you in there, I'll be happy. And really the whole premise is I've been through a lot of bear markets, and I've been through difficult times and I've been through good times. And I see a lot of people out there just kind of, throwing out this idea that option selling is this easy thing to do. And you're going to start making 10 grand a month and you're going to be able to quit your job. It's challenging. And a big part of the challenge is knowing when to stay away. Sitting on your hands is a position. Remember that. Cash and sitting on your hands is a very, very good position. And so some of the time it's going to be about realizing that and sitting back and and understanding that it's not the good trades that make your career. It's staying away from the bad trades. I don't know if that's something that people hear enough, but it really is true. And so I hope that's helped you guys out today. And David, thank you so much for having me here today. I really appreciate it.